Well, good morning, lovely people of YouTube. It's another blustery day down here on Port Elizabeth beachfront, and I'm going to go back to the office just now and make some updates for you. And there's a very interesting article that I've just come across, and if you're not a member of this channel, you can join by pressing the join button and just join. It's $7 a month, and you get all sorts of stuff that I glean from paid channels all over the internet, including Reuters and Bloomberg and JP Morgan articles and things like that. But I've got this interesting article which I'm going to go through with you and just highlight some of the main points. If you want to read the entire thing, just click the subscribe and join buttons below this video, and we'll talk about it's basically all about the dollar and where the dollar's heading over the next, let's say, quarter or 2 quarters or 4 quarters, and how that's going to influence the markets, including the stock markets, including gold and things like other commodities, and of course the major currencies, the euro, the pound, Canadian dollar, Swiss franc, etc. And particularly the Japanese yen, which we've been fighting against for quite a long time now, looking for this carry trade to unwind and for the yen to begin to strengthen. And it looks like that we're kind of in that sort of ballpark right now, where the Japanese yen might gather some strength, probably will, in fact. And this article by John Authers agrees that the carry trade, not only because of the carry trade potentially unwinding, but because of dollar weakening as well, and a bit of strength pre-programmed into some of the Asian currencies coming up over the next while. So there we go. We'll have a look at that when we get back to the charts. But in the meantime, I'm going to enjoy this stroll along the beach. And behind me is Bird Rock. And back there in the distance, I don't think you can see it right now, is the old Something Good Roadhouse, which has been here since at least the late 70s, I think, maybe the 80s, early 80s, where I used to be able to get a hamburger for about £1, which in today's money is about 5 US cents. So that's how old I am and how long I've been coming down to this beach for. So have a great day. I'll speak to you soon. I'll be back in the office shortly, and we'll go and have a look at some of the stuff on that article and a couple of the charts. Right, we made it back to the office, and this is the article by John Authers. I'm not going to actually reveal the entire article here because I have kind of kept this for my members, so I'm going to highlight it but pull out some of the most important points. And the article is called Points of Return by John Authers. The tide is high. There comes a time when the most reliable of trends has reached the point of exhaustion, and it's just possible that point is about to come for the US dollar. But that in turn might egg on the steady rise in bond yields, and that's a very important point to remember, and we have to keep that in mind. By any sensible measure, the dollar has staged an impressive rally over the summer, all the more so as other central banks have been seen as more likely to raise rates in the future. So we've seen the ECB and the Bank of England, both of those specifically and others, talking about their potential need to continue to raise interest rate hikes despite recession creeping into France and potentially Germany, and who knows, maybe even the UK. Still talking about interest rate hikes, which is interesting, but their inflation has not responded as well as it has done in the US, so perhaps there's a good argument for that. Bloomberg's dollar index, which includes both developed and emergency currencies, is at a high for the year and has broken above its long-term trend that runs against widespread expectation. There's a chart here. I'm going to show you my chart on the dollar index, and basically we've broken up through the 200 moving average, which is bullish in itself, I suppose, but it's not always a perfect indicator. People say when you get a golden cross or when you break above the 200 period moving average, it's a definite bullish sign. Well, it's not really, and just the same as a break below the 200 period moving average or a death cross, the moving averages isn't always bearish. In fact, in some cases, 1 or 2 of the stock names, when you get a death cross or a golden cross, often that's an inverse indicator of what the stock's about to do. Anyway, and the article goes on and saying this may be sustainable for the US and helps the Fed fight against inflation by making imports cheaper in dollar terms, but it's a problem for others. On a trade-weighted basis, Japanese yen is now at its weakest this century. Japan intervened to prop up the yen almost a year ago, and the currency is even softer now. So remember, it's not only the US dollar that the Japanese yen is being weighed against, but also the other currencies that are its trading partners as well, such as the European zone and Australia and various other countries in that region. So on a trade-weighted basis, the yen's actually even weaker than it looks when you compare it to solely the US dollar, for example. There's quite a telling comment here, and I'll read it to you. Are we at the point where the Bank of Japan feels compelled to intervene? Quite possibly. Masato Kanda, Japan's vice finance minister, said Wednesday, just a couple of days ago, in fact yesterday, if these moves continue, the government will deal with them appropriately, without ruling out any options. Japan watchers describe this as a clear warning that intervention is imminent. Just reading a little further down, therefore, the risk that the dollar's strength provokes a response from Japan looks considerable. Added to this, China, as discussed in points of return yesterday, is also reaching a point where it could feel forced to intervene. Any moves by either would likely have the consequences of pushing the dollar down and putting more pressure on US rates to rise further. The article then goes on to talk about the Beige Book and various other economic indicators and inflation and so on. I'm not going to read the whole thing to you right now. If you want to read the article, as I said, please just subscribe to this channel and then click the join button and you'll get access to the community pages inside this YouTube channel and all these articles and other videos that I do for community members. There's another really interesting part to this article, and the headline to it is, shouldn't the tech party be over already? And let's read it. The big tech flourished when they were low on the theory that the sector had a long duration. Its earnings were well into the future, so it benefited strongly from a lower discount rate. When rates surged in 2022, big tech tanked. That turned around this year as the tightening cycle came into sight, and crucially, artificial intelligence turbocharged new enthusiasm. But that rally surely can't last forever. Google's search data confirms that the initial surge of interest in AI following the launch of ChatGPT last November has now subsided. And this is quite a good indicator, actually, the Google search volumes, and anyone can go and have a look at it. Go and check it out yourself. Just type in to the Google search tool, ChatGPT or AI, and you'll see that the volume of searches has dropped off considerably. I did that myself. And yet the rally resumes. The graph below shows the ratio of the S&P 500 Information Technology Sector Index to the S&P 500, excluding tech, as a white line, gauge that excludes some of the mega cap companies such as Amazon, etc., which are not classified as tech stocks. Both tech-related indices outperform their non-tech peers and are close to their peak outperformance for the COVID era. And here's another interesting part of this article, which I'm going to read to you. The S&P 500 has gained 18% year to date, while the tech-heavy NASDAQ 100 has rallied more than double that. The gains were driven in a large part by the chip maker NVIDIA, seen as a big beneficiary of AI, which has rocketed up some 230% this year. But to Rob Arnott, founder of Research Affiliates LLC, the stock is a textbook story of a big market delusion. And here we quote, overconfident markets paradoxically transform brilliant future business prospects into even more brilliant current stock price levels. Arnott wrote in a research note, citing shares trading at around 110 times earnings. And I quote again from Arnott, NVIDIA is today's exemplar of that genre, a great company priced beyond perfection. And would NVIDIA's popping bring the whole market down? It's very possible. All right, another famous bubble hunter, Jeremy Grantham, has warned in an interview with Dave Rubenstein that we're descending from 2021's great bubble, and this should normally be the deflationary period. Read more about this in the Q&A. And there's more and more and more in this article. In fact, all of it's fascinating. I'm not going to go through the whole thing. So if you want to read it, just join the channel, join our community here. The last bit in here is survival tips, and there's a couple of things in here which are slightly interesting, and perhaps even more interesting than slightly. I'm not too sure. Depends on your level of conspiracy theory, I suppose. But here under survival tips, it says COVID-19 is inching its way back into our lives. Listening to the White House press secretary, that's Karine Jean-Pierre, bulletins on the president's COVID test before his travels was a jarring step back 3 years. There was also something quaint about it. COVID restrictions were annoying and latterly became increasingly inconsistent, but the pendulum has swung too far in the opposite direction. And there's a little bit more about that. Basically, what we can take away from this is that possibly we're aiming for a tech bubble deflation and a drop in the dollar, which would mean an increase in the value of the euro and other major currencies, the pound, Swiss franc, Canadian dollar, etc. And then also a potential rise in gold and other commodities, perhaps even natural gas and oil, and unwinding of the Japanese yen carry trade and some strength coming back into the Japanese yen. I've got a lot more thoughts about all of this, which I'll sort of condense as time goes on, but that's the gist of this, and I think it's a really good article and it's well worth reading, and I hope you have a fantastic trading day and trading week for the rest of this week. And the Rugby World Cup starts on Saturday, France against New Zealand. For all of those French And Kiwis watching, good luck. It'll be an interesting game, but as you know, probably the Springboks are going to win the World Cup at the end of the tournament. So we look forward to that. Take care.